Welcome, everyone, to today's lecture on Chapter 4 of the Conceptual Framework for Financial Reporting. In this lecture, we will be diving into the elements of financial statements. Here's what we will be covering. Contents of Chapter 4. 1. Introduction. 2. Definition of an asset, right, potential to produce economic benefits, control. 3. Definition of a liability, obligation, transfer of an economic resource, present obligation as a result of past events. 4. Assets and liabilities, unit of account, executory contracts, substance of contractual rights and contractual obligations. 5. Definition of equity. 6. Definitions of income and expenses. Introduction to the elements of financial statements. The elements of financial statements, as defined in the conceptual framework, are fundamental components that help in understanding a company's financial position and performance. These elements are categorized into two main groups. 1. Financial position elements. Assets, resources controlled by the entity that are expected to produce economic benefits. Liabilities, obligations of the entity to transfer economic resources to others. Equity, the residual interest in the entity's assets after deducting liabilities. 2. Financial performance elements. Income, increases in assets or decreases in liabilities that result in an increase in equity, excluding contributions from equity holders. Expenses, decreases in assets or increases in liabilities that result in a decrease in equity, excluding distributions to equity holders. These elements are interconnected with the economic resources and claims discussed in Chapter 1. Here's a brief overview of each element. Asset, a present economic resource controlled by the entity as a result of past events. An economic resource is a right that has the potential to produce economic benefits. Liability, a present obligation of the entity to transfer an economic resource as a result of past events. Equity, the residual interest in the assets of the entity after deducting all its liabilities. Income, increases in assets or decreases in liabilities that result in increases in equity other than those relating to contributions from holders of equity claims. Expenses, decreases in assets or increases in liabilities that result in decreases in equity other than those relating to distributions to holders of equity claims. Understanding these elements is crucial for interpreting financial statements and assessing a company's financial health and performance. We'll explore each of these elements in detail in today's lecture. Let's go through the explanation in much more detail and include thorough examples for each title and subtitle to ensure clarity. Definition of an asset. An asset is a present economic resource controlled by the entity as a result of past events. This definition includes three critical components. 1. Right. 2. Potential to produce economic benefits. 3. Control. 1. Rights. Corresponding to an obligation of another party. Rights that correspond to obligations from other parties can include rights to receive cash. This often occurs in sales made on credit. Example, a retailer sells a television to a customer on credit, where the customer will pay $500 in 30 days. The retailer now holds the right to receive $500 from the customer in the future. This right is considered an asset because it will generate future economic benefits for the retailer. Rights to receive goods or services. When a company makes an advance payment, it gains the right to receive goods or services in return. Example, an airline company pays $10,000 in advance to an aircraft maintenance company for future maintenance services. The airline has the right to receive maintenance services in the future, which is an asset because it has the potential to bring economic benefits by ensuring aircraft are in good working condition. Rights to exchange economic resources on favorable terms. This can be seen in derivative contracts like forwards and options. Example, a bakery enters into a forward contract to buy wheat at $200 per ton when the market price is $250 per ton. This contract gives the bakery a favorable term to buy wheat, which is an asset because it provides the potential to save money, thus increasing economic benefits. Rights dependent on an uncertain future event. These are often contingent on specific conditions being met. Example, a construction company has an insurance policy that will pay out $1 million if their ongoing project is delayed due to natural disasters. This insurance policy is an asset because it holds the potential to generate economic benefits if the specified event, a natural disaster, occurs. Rights, not corresponding to an obligation of another party. These rights exist inherently within the entity and do not depend on another party. Rights over physical objects. These include ownership or lease rights over physical items like buildings or equipment. Example, a manufacturing firm owns a piece of machinery used in production. The right to use this machinery to produce goods and generate revenue is an asset. Rights to use intellectual property. Intellectual properties like patents and trademarks fall under this category. Example, a tech company holds a patent for a unique software algorithm. The exclusive right to use this algorithm is an asset, as it can be utilized to develop software products and generate sales. Establishment of rights. Rights can be established through various means, such as contracts, legal agreements granting specific rights. Example, a company signs a lease contract for office space, giving it the right to use the office for a specified period. This lease is an asset because it grants the company the right to use the office space to conduct its operations. Legislation, government grants or regulations that provide rights. Example, a telecommunications company receives a license from the government to operate cellular networks. This license is an asset because it allows the company to provide services and generate revenue. Other means, developing proprietary knowledge or processes. Example, a pharmaceutical company develops a new drug formula that is kept as a trade secret. The exclusive right to use this formula in production is an asset. Exclusions. Not all rights qualify as assets. Public rights, rights accessible to everyone without significant cost. Example, the right to access public roads is not an asset for any company because it is available to everyone without cost. Self-issued instruments, instruments like treasury shares or own-issued debt held by the entity. Example, a company repurchases its own shares and holds them as treasury stock. These shares are not assets because they do not represent economic benefits to the company. Aggregating rights. Related rights are often treated as a single unit of account. Legal ownership of a physical object includes multiple rights related to the object. Example, owning a delivery truck includes the rights to use, sell, lease, and pledge the truck. These combined rights are accounted for as a single asset. 2. Potential to produce economic benefits. An economic resource must have the potential to produce economic benefits. This potential does not need to be certain or even likely. It just needs to exist in at least one scenario. Ways economic resources produce benefits. Economic resources can produce benefits in various ways. Receiving cash flows, regular payments such as interest or dividends. Example, a company holds a bond that pays $1,000 in interest annually. This right to receive interest payments is an asset. Exchanging resources on favorable terms, benefiting from advantageous trade conditions. Example, a company has a contract to buy raw materials at a below-market price, which allows it to save money and increase profitability. Producing goods or services, using resources to generate revenue. Example, a bakery uses its ovens to bake bread, which it sells for profit. The ovens are assets because they help in generating revenue. Selling the resource, converting the asset into cash. Example, a company sells a piece of real estate it owns for $1 million. The real estate was an asset because it could be sold for a significant amount of money. Avoiding cash outflows. Reducing expenses through ownership. Example, a company owns its office building, which means it doesn't have to pay rent. This ownership helps the company save on rental expenses, providing economic benefits. Example of low probability benefits. Even if the probability of benefits is low, as long as the potential exists, the item can still be considered an asset. Example, a biotech firm holds a patent for a drug that may not become a market success. Despite the low probability of high sales, the patent is an asset because it has the potential to generate economic benefits. Hopper 3. Control. Control means the entity has the ability to direct the use of the resource and obtain the benefits. Aspects of control. Direct use. The entity can use the resource in its operations. Example: a manufacturing company uses its factory to produce goods. The factory is an asset because the company controls and uses it to generate products. Preventing others from using it. Ensuring no one else benefits from the resource. Example: a software company with exclusive rights to a particular technology can prevent others from using it, ensuring only the company benefits from its use. Legal rights and other means. Control is often through legal rights, but can also be through other means, such as exclusive access. Example: a firm has access to proprietary technology that is not publicly known. This exclusive access means the firm controls the technology even if it is not legally protected by a patent. Control and economic benefits. For an entity to control an economic resource, the benefits must flow to the entity, either directly or indirectly. Direct benefits. Using the asset to generate revenue directly. Example: a retail store uses its inventory to make sales. The inventory is an asset because it helps generate sales revenue. Indirect benefits, enhancing other assets or operations. Example: a company uses a specialized software program to improve its production efficiency, indirectly benefiting its overall operations. Principal-agent relationship. If a principal engages an agent, the resource controlled by the principal is not an asset of the agent. Example: a retailer, principal, hires a logistics company agent to manage its inventory. The inventory remains the asset of the retailer, not the logistics company. Comprehensive example. Consider a company that owns a fleet of delivery trucks. Right. The company has legal ownership and can use, sell, or lease the trucks. Potential to produce economic benefits. The trucks help in delivering products, generating revenue. They can also be sold if needed. Control. The company decides how to use the trucks and maintains them, preventing others from using them. These trucks are assets because they are economic resources controlled by the company, with the potential to produce future economic benefits. Conclusion. Understanding assets is fundamental to financial reporting and accounting. By recognizing what constitutes an asset, companies can accurately report their financial position and performance. Definition of a liability. A liability is a present obligation of the entity to transfer an economic resource as a result of past events. For a liability to exist, 3 criteria must all be satisfied. 1. The entity has an obligation. 2. The obligation is to transfer an economic resource. 3. The obligation is a present obligation that exists as a result of past events. Let's break down each of these criteria in detail, providing comprehensive examples to ensure a clear understanding. Obligation. Obligation refers to a duty or responsibility that an entity has no practical ability to avoid. This obligation is always owed to another party or parties, which could be individuals, other entities, groups, or even society at large. The identity of the party or parties to whom the obligation is owed does not necessarily have to be known. Examples of obligations. 1. Legal obligations. These are established by contracts, legislation, or similar means and are legally enforceable. For example, a company, ABC Corp., borrows $1 million from a bank. ABC Corp. Has a legal obligation to repay the loan with interest according to the terms of the loan agreement. 2. Constructive obligations. These arise from an entity's customary practices, published policies, or specific statements. For example, XYZ Limited has a policy of paying year-end bonuses to employees based on company performance. Even if not legally obligated, XYZ Limited has a constructive obligation to pay these bonuses because it has created an expectation among employees. 3. Conditional obligations. These depend on the entity taking a specific future action. For example, DEF Industries operates a factory and must clean up any environmental damage if it continues to operate in that location. The obligation to clean up is conditional on continuing operations. Transfer of an economic resource. The second criterion for a liability is that the obligation must be to transfer an economic resource. This means that the obligation must have the potential to require the entity to transfer an economic resource to another party or parties. Examples of transfer of economic resources. 1. Obligations to pay cash. A company, GHI Limited, owes $20,000 to a supplier for goods received. The obligation to pay cash to the supplier is a liability. 2. Obligations to deliver goods or provide services. A construction company, JKL Builders, has received an advance payment of $100,000 for a building project. JKL Builders has an obligation to complete the construction project. 3. Obligations to exchange economic resources on unfavorable terms. M&O Inc. has entered into a forward contract to sell oil at a price below the current market value. This obligation to sell oil at a lower price is a liability. 4. Obligations dependent on an uncertain future event. PQR Limited may have to pay damages if it loses a lawsuit. The obligation exists even if it is uncertain whether PQR Limited will lose the case. 5. Obligations to issue financial instruments. If a company, S2 Corp, has issued bonds, it has an obligation to pay interest and repay the principal amount to the bondholders. Present obligation as a result of past events. The third criterion for a liability is that the obligation must be a present obligation resulting from past events. This means that the entity must have already obtained economic benefits or taken actions that result in the obligation to transfer an economic resource in the future. Examples of present obligations. 1. Obtained economic benefits. A company, VWX Limited, has used raw materials received from a supplier. The obligation to pay for these materials is a present obligation resulting from the past event of receiving the materials. 2. Taken an action. A company, YZA Corp., has signed a lease agreement for office space. The obligation to pay rent is a present obligation resulting from the past event of signing the lease. 3. Legislation or constructive obligations. If a new law requires companies to pay for pollution control equipment, the obligation arises only when the company continues to operate in a way that causes pollution. The mere enactment of the law does not create a liability. 4. Conditional on future actions. If a company, BCD Enterprises, agrees to pay a bonus to employees based on meeting certain performance targets, the obligation exists only when the targets are met. Before that, it is a potential obligation. Comprehensive example. Example of a liability. ABC Limited manufactures electronics and sells them to retailers. ABC Limited has received a shipment of raw materials from a supplier and has agreed to pay $50,000 for these materials within 60 days. Additionally, ABC Limited has signed a contract to deliver 500 televisions to a major retailer next month and received an advance payment of $20,000. Analysis. 1. Obligation. ABC Limited has an obligation to pay $50,000 to the supplier and an obligation to deliver 500 televisions to the retailer. 2. Transfer of economic resource. The $50,000 payment to the supplier and the delivery of 500 televisions are transfers of economic resources. 3. Present obligation as a result of past events. The receipt of raw materials and the advance payment for televisions are past events that create present obligations for ABC Limited. In this scenario, ABC Limited must recognize liabilities for the $50,000 owed to the supplier and the obligation to deliver 500 televisions. These liabilities are recorded in ABC Limited's financial statements, reflecting the company's present obligations to transfer economic resources as a result of past events. Conclusion. Understanding liabilities is crucial for accurate financial reporting and decision-making. Liabilities represent obligations that can significantly impact an entity's financial health. By comprehensively analyzing and recognizing liabilities, entities can provide transparent and faithful representations of their financial positions. The detailed examples provided illustrate various types of obligations and how they manifest in real-world scenarios, aiding in a deeper understanding of this essential financial concept. Assets and liabilities. Assets are things a company owns that have value and can be used to generate money. For example, cash in the bank, buildings, and equipment are assets because they contribute to a company's ability to operate and make profits. Liabilities are what a company owes to others. This could be loans, bills that need to be paid, or promises to deliver goods or services in the future. Liabilities represent financial obligations that the company needs to fulfill. Unit of account. The unit of account is about how companies group and report their assets, liabilities, income, and expenses in financial statements. It's important because it impacts how information is presented to users of financial statements. Example. Imagine a company leases office space. Instead of reporting each lease separately, they might group all similar leases together to give a clearer picture of their total lease obligations. Executory contracts. Executory contracts are agreements where both parties still have things to do. This means neither party has completed all their obligations under the contract. Example, a contract to build a house is executory until the builder finishes and the buyer pays in full. Both parties have ongoing responsibilities until the house is completed and paid for. Substance of contractual rights and obligations. This concept focuses on the real economic impact of contracts, not just their legal form. It ensures that financial statements accurately reflect the true nature of agreements between the company and others. Example, a software subscription contract includes not just the payment terms, but also the implicit support services provided by the company. Even if not explicitly stated, these support services are crucial for the customer and affect how the company reports its revenues. Understanding these concepts helps anyone, whether they're studying business or not, to grasp how companies communicate their financial health and responsibilities to the world. It ensures transparency and helps stakeholders make informed decisions about investments or business relationships. Understanding equity in financial reporting. Definition of equity. Equity represents the ownership interest in a company. It is what remains after subtracting all liabilities from the company's assets. This residual interest belongs to the shareholders. Example, if a company's assets total $1 million and its liabilities are $400,000, the equity would be $600,000. Types of equity claims. Share 1. Shares. Shares represent ownership in the company and can be of different types. Ordinary shares. These typically carry voting rights and a residual claim on assets after all other claims have been met. Example, owning ordinary shares in a tech company gives you a claim to part of its profits and a vote in major decisions. Preference shares. These often have priority in receiving dividends before ordinary shareholders, but may have limited or no voting rights. Example, preference shareholders might receive a fixed 5% dividend on their shares before any dividends are paid to ordinary shareholders. 2. Obligations to issue equity. Sometimes, companies have commitments to issue more shares in the future, such as through stock options or convertible bonds. Example, if a company has issued stock options to employees, these options, when exercised, will convert into shares, increasing the equity claims against the company. Different classes of equity. 1. Dividend rights. Shareholders may have the right to receive dividends if the company decides to distribute profits. Example, preference shareholders might receive a 5% dividend on their shares before any dividends are paid to ordinary shareholders. 2. Liquidation rights. In the event of company liquidation, different classes of shareholders have different rights to the remaining assets. Example, if a company goes bankrupt and is liquidated, preference shareholders are paid from the remaining assets before ordinary shareholders. Legal and regulatory aspects. Legal and regulatory requirements can affect how equity is managed and reported. 1. Distribution restrictions. Regulations often require companies to have sufficient distributable reserves before they can pay dividends. Example, a company might need to retain a certain portion of its earnings as reserves, which cannot be distributed as dividends to ensure it can meet future liabilities. 2. Share capital and retained earnings. Companies must adhere to legal requirements regarding the management of share capital and retained earnings. Example, legal regulations may mandate that a company maintain a minimum level of share capital and restrict the use of retained earnings for dividend payments unless certain financial conditions are met. Equity across different entities. The concept of equity applies to various types of business entities. Tranche 1. Sole proprietorships. In a sole proprietorship, the owner's equity is the residual interest in the assets of the business after deducting liabilities. Example, a sole proprietor can withdraw profits from the business at any time without legal restrictions. 2. Partnerships. In partnerships, partners share the residual interest in the assets of the business according to their partnership agreement. Example, in a partnership, profits are distributed according to the partnership agreement, which might specify that one partner receives 60% of the profits and the other 40%. 3. Trusts and government business undertakings. These entities have unique legal and regulatory frameworks, but the principle of equity as the residual interest remains applicable. Example, in a trust, equity might be distributed to beneficiaries according to the terms of the trust deed, while government business undertakings may have specific rules for the distribution of surplus funds. Comprehensive example. Imagine a technology startup, Tech Innovate, which has the following financial structure. Assets, $1 million. Liabilities, $400,000. Equity, $600,000. Calculated as $1 million, $400,000. Tech Innovate has issued different types of shares. 1. Ordinary shares. These give shareholders voting rights and a claim on residual profits after all obligations are met. Example, shareholders holding ordinary shares can vote on major company decisions and receive dividends from the remaining profits after preference shareholders are paid. 2. Preference shares. These shareholders receive fixed dividends and have priority over ordinary shareholders in case of liquidation, but usually do not have voting rights. Example, preference shareholders receive a fixed 6% dividend annually before any dividends are distributed to ordinary shareholders. In case Tech Innovate is liquidated, preference shareholders will be paid from remaining assets before ordinary shareholders receive any proceeds. Tech Innovate is also subject to regulatory requirements that restrict dividend payments unless the company has sufficient retained earnings. Legal restriction example. Tech Innovate can only distribute dividends if it has sufficient retained earnings specified by regulatory requirements. By understanding these principles, stakeholders can better interpret a company's financial health and the implications of its equity structure. This understanding helps in making informed decisions about investments and assessing the company's financial stability and growth potential. Understanding income and expenses in financial reporting. Definitions of income and expenses. Income refers to increases in assets or decreases in liabilities that result in a boost to equity, excluding contributions from equity holders. Example, when a company sells products or provides services, it earns revenue, which increases its assets like cash and equity, profits. Expenses are decreases in assets or increases in liabilities that lead to a reduction in equity, excluding distributions to equity holders. Example, paying salaries or purchasing supplies are expenses because they decrease assets, cash, and reduce equity, profits. Key points. 1. Impact on equity. Income and expenses directly impact a company's equity by either increasing or decreasing it based on their nature. 2. Exclusion of equity contributions and distributions. Contributions from equity holders, like issuing new shares, are not considered income. Similarly, distributions to equity holders, like dividends, are not expenses. 3. Financial performance indicators. Income and expenses are critical components of financial statements that reflect an entity's financial performance. 4. Different characteristics. Various transactions generate income and expenses with distinct attributes. Reporting them separately helps stakeholders understand an entity's financial performance more accurately. Importance in financial reporting. Comprehensive insight. While assets and liabilities showcase a company's financial position, income and expenses reveal its financial performance over a period. Decision-making. Investors and creditors rely on income and expense information to assess profitability, operational efficiency, and sustainability. Transparency. Providing clear and detailed information about income and expenses enhances transparency in financial reporting, fostering trust among stakeholders. By understanding income and expenses, stakeholders gain insights into how a company generates revenue, manages costs, and ultimately impacts its financial health. This knowledge aids in making informed investment decisions and evaluating a company's overall financial well-being. Conclusion on elements of financial statements. In conclusion, the elements of financial statements, assets, liabilities, equity, income, and expenses are fundamental pillars that collectively depict the financial position and performance of an entity. Each element serves a crucial role in financial reporting, providing stakeholders with comprehensive insights into a company's operations and financial health. Importance of elements. Assets and liabilities. These reflect what the company owns and owes, forming the basis of its financial position. Equity represents the residual interest in assets after deducting liabilities, indicating ownership interests. Income and expenses showcase the financial performance by detailing revenue generation and costs incurred over a period. Significance in decision-making. Understanding these elements empowers investors, creditors, and other stakeholders to make informed decisions. They use financial statements to assess profitability, operational efficiency, and the overall viability of an entity. Transparency and trust. Clear and accurate reporting of these elements ensures transparency in financial disclosures, building trust with stakeholders. It enables comparisons across periods and with other entities, facilitating robust financial analysis. Looking ahead, as we conclude Chapter 4 on the elements of financial statements, I encourage you to subscribe and like our channel to stay updated. In our next lecture on Chapter 5, we will delve into the Conceptual Framework's recognition and derecognition principles. Understanding these concepts will further enhance your grasp of how transactions and events are recognized in financial statements. Thank you for joining today's lecture. I look forward to seeing you in Chapter 5 as we explore more insights into the conceptual framework of financial reporting.